So, like I mentioned in the last video, what we're going to go through today is short-run profits and losses. Now, I already went through a little briefing with you guys, and what I pretty much said in the last video is we can find if a firm is profiting pretty much by comparing the firm's average total cost curve to the price. So that's what we're going to do, and we're going to do that by looking at these three graphs. It's actually really simple. Let's take a look at this first graph. This first graph, we have price equaling at the average total cost. So in this case, we are pretty much breaking even, and in this situation, we are making zero economic profit. Now, what happens when the price is actually greater than our average total cost? Well, in this case, the price will exceed the average total cost, and that means a positive economic profit. Our fixed cost, or our total cost of producing sweaters in this case, is actually less than the price we're selling it for. So what that means is we're making profit. Now in the reverse situation, opposite situation, the price is less than the average total cost curve. And in this case, it's economic loss or negative economic profit. The price that we are selling for these, the price we are selling these sweaters for are less than the average total cost we are making them for, and therefore we are incurring a loss in the end. Now, in short-run equilibrium, a firm can profit, break even, or even incur a loss. Only one of them is in long-run equilibrium, because firms can enter or exit the market, and new firms enter an industry in which existing firms are already making a profit. So pretty much these new firms are running to where the money is. Firms exit an industry when there is economic loss. So pretty much the losers who thought there was money, but then that economic profit is not there anymore, they will pretty much just leave the industry to go find something else to do. So let's look at entry a bit more. So what we have here is we have an example where the market price is $25 a sweater, and firms in the market are making an economic profit, because what we have, you can see just from these two graphs that there is an equilibrium for supply and demand, and price is actually greater than the average total cost. And in this case, at this amount, where we're producing nine sweaters per day, we're actually making economic profit of 5, because we're selling them at 25, and at 9 sweaters per day, with the cost of actually producing these, the average total cost is actually $20. So in this situation, new firms have an incentive to actually enter the market. Now, when they do, the market supply will increase and the market price will decrease. So firms will enter as long as other firms are profiting. So in the long run, this is what happens. In the long run, the market supply increases and the market price falls, and the firms start to break even. So pretty much here, need to get a highlighter, I guess. So here is pretty much where we were before. This was our equilibrium of supply and demand when new firms weren't entering the market. But once they entered the market, what actually happened is, well, the market price fell. First of all, the market price fell. So in this extreme case, the market price fell to this level, and the market supply increased. So pretty much we went from 7 to 8. So in this situation, you can see that firms started to break even. You can see that in this case, the the price is actually equal to the cost now. So these firms are now actually dumbing down on their production, and they're making 8 sweaters per day as compared to before when they were making 9. So that's that. So what basically happened was new firms saw that there was an economic profit currently made by existing firms that are that were making money in the market. These new firms entered the market, and when they entered the market supply for these items quickly increased, and due to the increase in supply, the market price for that particular item fell, and as more and more firms enter the market, because of them seeing that the existing firms are profiting, this will keep happening until pretty much all the firms break even. And that is where I'll stop. In the next video, we'll take a closer look at exit, and we'll see how or why firms exit. Other than that, please rate, comment, and subscribe, and I'll see you guys in the next video.